Hi, this is Gary Munson, co-founder of Main Street Alternative Asset Planners. I wanted to give you an alternative to bank CDs that pay anywhere from 5 to 8 times the return with a similar type of risk. This is low risk. Rates are fixed and secured. Let me give you a summary of what it looks like. Here's a sneak peek. It's 9.4% for 5 years. This is secured on a great piece of rental property. This has reduced default risk. This has simplified ownership transfer in case there is a default. And if there were a default, the default creates a return if you want to continue and hold the property of around 30% on your invested dollar or a 90% principal increase if you want to hurry and sell the property at a reduced price. How does that sound? Let me go into give you some more detail if you like it. Hey, these are what we call mortgage notes, or some people call it trust deed financing. But what it is this is tangible, titled ownership. This has a fixed rate of return. Our clients receive 8% interest paid to their account monthly. Now, at the end of 5 years, they're paid a bonus of 5% of the principal that they put in. And so if they did a $20,000 note, they'd get back an extra $1,020, something like that at the end of 60 months. So what that makes is the net return in the 9.4% range. Hey, I'll show you some more information. But what you need to know is the banks have kind of pulled up their stakes and left town. There is a vacuum left where banks used to take great positions and lend that they're just not doing it anymore. And so they're afraid of future demands for documentation that might make their loans invalid in the future. And so they just aren't doing anything right now. These are what we call non-recourse loans. Now, the reason it is because a lot of our clients are buying this real estate with their retirement programs. And so when we're using retirement dollars, the IRS requests or requires that the loans are called non-recourse, which means the loan is just based on the property itself. It's not going back to the individual who signed for the loan. So these guys automatically qualify, and when we underwrite the loan, we're just looking at the home itself because this is the way that the IRS requires it. Well, they offset the risk by not being able to go after the person who signs for the loan by lowering the percentage of the purchase price that they will lend. The industry calls it a loan to value. And so we do about a 50% of the purchase price. So if these properties cost $50,000, then we'll have our clients loan up to $25,000, which leaves lots of room if the market happens to drop a little bit more in the future. And so if a property goes back to our bank or clients and they need to sell it for at a reduced price in a hurry, then they can still get all of their money back. And so that's how we do this. Normally banks like to do an 80% position, and we're doing 50% to make up for the difference. Well, banks know what's going on with money, and in fact, we're giving our clients the opportunity to take that very comfortable spot customarily held by a bank. And there's a great picture, bankers, the house always wins. But what you need to know about this situation is the buyer of the home, the person who wants to buy this property, is in love with the property. It's in a good position. They kind of shake everything down to make sure it's a great property. Our clients lend half of the purchase price. They are secured on the title with the county, so there's no monkey business. There's nothing funny going on. If there's a default, our clients own the property. They are protected with homeowners insurance. The buyer of the home has to go buy an insurance policy that names our clients as the payoff person. So if the house burns down, the check is written to our clients. And it's generally done at about 3 to 4 times of the loan amount. And we'll talk about that in just a minute. But first things, buyer is in love with the property. A buyer is generally going to earn 12 to 24% rate of return on these properties. The home has almost always been purchased at foreclosure and is fully renovated back up to good rental quality standards. Now, the property, before our clients buy it, has a rent-paying tenant in place with a long-term lease, 1 to 2 years. And then they go out and they find a property manager to take care of that property for them. So these clients are so happy. They've got a place where their money is going to work big time, but they're protected by owning something tangible. Well, in order before they buy the property, they also have an independent property inspector or home inspector come in and crawl around up in the attic and down and around the furnace room and just check out everything and give them a full report of the complete status. And whenever these buyers get a home inspection, we forward that home inspection to our clients as part of their due diligence process. And then, of course, we ensure that this home is insured for a year, not only for the homeowner's insurance, but they usually buy a home warranty as well to cover the major challenges over the first year. And so what this nets out to be at the end of the day is protection for our money. This is tangible ownership. If something goes wrong, we're standing there ready to take over. This is recorded at the county. These are reduced chances of default. And what I mean is when the client comes in with 50% of the purchase price, that's a lot of skin in the game. And these guys, chances of them defaulting is really reduced. Well, we also have them sign at closing an assignment of rents. And so if they do default, then it's easy for our clients to get with the renter and redirect where the rents are coming. And we also have a process that simplifies the transfer of ownership in the event of a default. We've tried to make this just really as bulletproof as possible for our clients as they work being the lender in these situations. What do the properties look like? Here's a property in St. Louis. The client was very happy to buy it. The purchase price, you can see there was $45,000. If they purchased it with cash, $45,000, that net rents that comes out after the taxes and the insurance and the homeowner's insurance is paid, and also the property management fees, that net $6,700 a year. That's $750 a month in rent. And so our client makes 15% on their money. But if we introduce them to a good lender, a non-recourse lender that will come in and finance $20,000 on this loan, then the client's happy to pay that $1,600 of interest for the year because they're still netting $5,100 on their investment of $25,000, or the net return for them is 20%. So they're very excited about buying this property, and they're very excited about making their payments. Now the payment on a $1,600 thing, it's about $150 a month. And so the notes tell them that if they're late, if the payment isn't received by the 10th, it's a $50 late fee. So they don't want to pay that. They're going to pay this thing on time. And so we just set it up to where they get an electronic funds transfer into their bank account for that monthly payment. So here's what it looks like. Again, the purchase price was $44,000. Ended up being $500. If our note was $22,450, which is half price or half of the purchase price, our clients would bring in 95% of that note amount. So they would wire transfer to the title company $21,327. Now, 8% monthly interest is paid on the note amount of $22,450. So there's that $1,800 a year that's coming in. Divide that by 12, it's about $150 a month. And so if we continue to do that for 5 years, that's $8,980 that's collected over 5 years. Now, when the note pays off, they pay back $22,450. You only lent them $21,327. So that creates what they call this discount or this bonus of $1,123. So total returned over 5 years, $10,103. Divide that by the 5-year period of time, and that's $2,020 a year. Or dividing that by the amount of money we had in, 9.47 rate of return. When CDs right now, I checked yesterday online, the best CD I could find for a 5-year agreement was 1.75. Or if you gave them $500,000, they'd give you 1.85%. So that's more than 5 times the amount of money people are earning on CDs. So here's a great situation. Now again, is default bad? Now if you had to take over the ownership, do the transfer, and take care of it, the net rents on that property after paying the taxes, the insurance, and the property management fees, what they got net, $6,754 a year. Our client lent $21,327 on the note. So the banking position, or our client that lend, has a couple of choices. They could sell it quickly for 90% of what the person paid for it, and sell it quickly. So the purchase price, $40,000. So they pick up $18,643 plus whatever rents they'd collected over time. So not a bad situation to really improve and increase the value of that investment. Or if, heaven forbid, they decide to just keep renting it and have the property manager take care of the home, that $6,754 a year divided by the $21,327 that we were in it, assuming no rents were collected. But that's a 31.6% net rate of return. I don't know where you get a solid, stable, fixed return that's better than that. So if this is a question, is default bad? And it probably isn't in the situation. But hey, here's what you want to watch out for. We want to make sure that the homeowner's insurance is paid annually, because that's what's protecting your security. And so we want to make sure that home is protected if perchance it is damaged. So they buy it at closing. You want to talk to them a year out, make sure that it's paid again. We want to make sure that the taxes are paid. So we don't want the city to move in front of us on the lien position on title. So we want them to prove that the taxes are paid. And then collecting funds, we've got a couple of ways we can do that. We have an escrow company that for a fee will establish and collect the funds from the home buyer and forward the difference to you. Or we can just establish an EFT, an automatic funds transfer, right into your bank account from the borrower. At the end of 5 years, they've got the opportunity. You can look around and renew the note if you want. If CDs are still paying less than 2%, then hey, you may want to renew that note. If inflation goes crazy and CDs in the bank are paying 12, then you may want to renegotiate and put your money in the CD if you'd like. But that is your choice at that time. And then can they pay you out? And it's interesting, their net returns, a lot of these guys could just save the returns and literally pay you off at the end of 5 years. So, so that's the things that you want to be concerned about. But these are a great position in this market to get really 5 to 8 times what CDs are paying, where we're secured and in a great position. I'd like to talk to you more about this. And if you'd like to learn more about what we're doing, please, enter your information and click the button there down below or at the left, and we'll give you some more information about what we do. Thanks very much, and take good care.